market's seeing plenty of room for the Fed to cut amid easing inflation concerns. But Justin Dercole, a longtime head of Barclays' fixed income syndicate business, is pushing back, writing, quote, "There's an expectation that these higher rates are very restrictive, and we're waiting for the consumer shoe to drop and wipe out the labor market. If that were going to happen, it would have happened already." Justin, who currently is the head of ISO-mts Capital Management, joins us now. Justin Dercole, I want to start with that. Why are you pushing back so aggressively on this?
Yeah, so the beauty of focusing on banks, which is what we do, is we have a particularly strong lens into the economy. And so what we're seeing is that asset quality is actually trending better. And that ultimately, if you were going to get the long and variable lags that get so much attention in the press, they would have happened already. It would be transmitted through the credit channel, Lisa, and that just hasn't happened. So if I am a bank, most of the large banks, all of the large banks really are well capitalized. Their profitability is better than it's been since the global financial crisis, and their asset quality trends are moderating. And so you put all those things together and the banks are going to lend. And so if they're willing to lend, ultimately a consumer that is now getting used to these higher interest rates, you put all that together and overlay a capital market environment that's been very favorable. Credit spreads have been near their tightest levels of the last 20 years, going back a couple of weeks. We've had a little bit of a blip in the last week and a half, 2 weeks. But I put all of that together, and then I'll either turn on the TV, listen to the radio, read the press, listen to pundits, and I really have no idea where people are getting this risk to the economy.
Well, hold on a second, Justin, because I'm sure that you hear a lot of those people here on Bloomberg Surveillance. They come on, the Neil Duttas of the world. We'd love to get you guys in the same room, coming on and basically saying, what is the rush? This is the time. What is the holdup? This is the time. What are they waiting for? Let's go. Justin, how do you sort of dismiss some of the concerns that we're seeing from a lot of corporate executives that are coming out and saying the consumer is feeling weak? What do you say about Home Depot saying that they're waiting for rates to be lower to actually make those purchases?
Right. So I think that's an important point. So the consumer has been waiting. And I think so if you look at loan growth, it's been very tepid. It's finally started to pick up. If you look at the Fed's H8 report that came out last week, loans are finally picking up. So what I would say is there are two dynamics here. One dynamic is companies and CEOs, if they're having issues, it's very easy for them to point to a consumer that is challenged. And I don't want to say place blame, but effectively use this crutch to help them talk about their challenges. The reality is that, and this last payroll report probably stands out to me the most as being so completely different than what the narrative was. 200,000 workers were impacted by weather. And I don't know how the BLS said that weather wasn't a consideration. I don't get that. It didn't make any sense to me. And so there's almost certainly going to be a get back in the next payroll report based on the weather effects. So here's what I would actually ask the CEOs who are talking about a challenged consumer. The second quarter grew at 2.8%, and retail sales were very strong in June. We're getting retail sales tomorrow. The strength at the end of the second quarter means that the third quarter is almost certain to get off to a strong start. Goldman has a Q3 GDP tracker that they're already out with, and I think it's in the mid twos. Atlanta Fed GDP now is in the high twos. So when is the future the present? That's what I want to know, and I really just don't get.
Justin, what we've heard from CEOs, though, if I could just interrupt you for a second, is there are two different types of consumers. What does the Fed need to do for those that are struggling on the lower end, that aren't impacted by the stock market and all-time highs we've seen because they're not exposed to money markets and stock markets?
Yeah, so there's another issue there that is disconnected from reality. So there is a report from Barclays that came out after Q1. So it's a little bit dated, but I mean, relatively recent. And if you actually look at the underlying spending trends, the lower end consumer actually was doing better in the first quarter from a consumption standpoint than higher end consumers. So again, what I would say is, I'm not sure that what you're hearing is reality. And let me try and like put a fine point on that. Okay. If I'm a lower end consumer, wages are growing right now at a much higher rate than they did pre-COVID, certainly, and immediately post-COVID. Okay. So you have better wages. You have a growth in a rise in the unemployment rate that is because new entrants are coming in. Now, let me ask, so some of it's immigration, but why are new entrants coming in?
Justin,
because
can I ask another flavor of this? Because you're talking about the strength in the consumer, that the long and variable lags haven't arrived. What do you make of just inflation then coming back down to the Fed's target?
Right. And so therein is the interesting dynamic. If the neutral rate is higher, which I would say, and this is the point I actually think is most important, the neutral rate is higher. At some point, you have to reconcile that. Otherwise, the market is taking down duration, financing this deficit at the wrong levels, at too low a yield in aggregate. And that's a concern. So what I would say about the inflation is that there is an expectation every time inflation gets down here that it's just going to keep going straight down. I don't think that's realistic. And most people agree with that. And yet the market doesn't want to trade it that way. It just wants to assume that it's going straight back to 2%. Last point, let me just make. In 94 and 95, there was this mid-cycle adjustment people talk about. That was after a negative payroll print, the Fed cut in 95. So we're nowhere close to that. You're running payrolls after we get this give back. You're probably running payrolls close to 200,000 a month.
Yeah.
It's totally like the narrative and reality are disconnected. It's finally going to come home because at some point the market will have to say, how are we living with a 5% policy rate now for 12 months?
Yeah.
So we have ex post data that supports this idea that the neutral rate is higher.